Trent Bradshaw, Brandon Rogers, Bradshaw Financial Planning and Mind Your Money. Thank you for joining us for this market update. Today is August 31st, 2022. A couple items that we're going to talk about today. We'll actually touch on earnings. We're getting closer to where all the companies in the S&P have reported their earnings. We'll talk a little bit about that side of the equation along with sales growth. The second thing that we'll touch on, what do we expect on interest rate increases throughout the end of the year? And then the third thing that we'll touch on is the latest meeting that the Fed had over in Jackson Hole, and then how we think that's going to impact the portfolio and what kind of adjustments did we make. All right, let's jump right in. First chart we're going to look at, let's take a look at the overall earnings for the S&P 500 because I think this is important. What we saw coming out of the second quarter compared to what expectations were actually came in a little bit better. If you look at the overall sales growth was just shy of 14% for the companies that have reported. Roughly about 95% of the companies have reported at this point. Earnings per share growth was between 7 and 8% growth during the second quarter, which was a lot better. We were expecting negative earnings growth during the second quarter, which was a surprise. The biggest thing in regards to that, the other variable was the interest rate environment that we're in. If you look at interest rates on the second chart that we take a look at, what you'll see is we still have inversion. And inversion, as we talked about before on previous videos, is a precursor to potentially having a recession.
But also too, with that inversion, what that's meaning is that usually if you think about a CD, if you hold a CD for a long period of time, you expect to get probably a higher return if you hold it for a long period, right?
Right.
Well, when that inversion happens, it means your short-term periods are basically doing better than your long terms, and you just kind of scratch your head on that one. So. Yeah,
I mean, T-bills that are 90-day government issued paper all the way through 2 years. I mean, there's opportunity right now to get 3.5% yields on that. Yeah. So if you've got some stagnant money sitting in a money market account, checking account, savings account, whatever, you do have opportunity of getting a pretty nice yield on it if you want to take advantage of it. Yeah. If you got any questions regarding that, give us a ring. The last thing that I wanted to touch on was pretty much the expectations when it comes to interest rates from this point forward going into the end of the year. Based on what we're seeing from a probability standpoint, it looks like it's going to be anywhere from 1.25 to 1.5% as far as an additional increase before the end of the year. That'll probably come in two separate rate hike decisions that will come in September into the end of the year. But ultimately, it's kind of expected from what we had talked about before. The Fed is not going to back off.
No, I mean, I think they've been pretty clear about, hey, they're going to keep the foot on the gas until we get this inflation deal under control. That's what they're doing. It just takes time for them to get the data to see, hey, is this what we're doing is working? So they've been really aggressive this year, of course, by raising rates. We can all feel that. But then also, we got 3 more meetings, right? Pretty much.
Right, for the end of the year.
Potential increases. Yeah.
To the end of the year. Ultimately, the Fed did state on Friday, exiting the Jackson Hole meeting, as far as their comments, they are willing to allow unemployment to go up. Right now, it's historically low in the mid-3s. They're probably willing to see that unemployment number creep up to around the 5% number. That gives them additional firepower to stay aggressive with these rate hikes. Now, that in turn normally is a negative thing when it comes to the market and also several asset classes, which justified us making a change here at the end of August to concentrate on more of what asset class?
Yeah, so what we did, we made some changes, so again, some minor tweaks. We are bringing back still large cap, talking about quality companies when we say that, so big time names that you all recognize, but then leaning on the side of value, leaning on some of the dividend payers from that end, consumer staples, again, just think about the things that you use on a daily basis, and then also utilities. So, and then again, like I said, the dividend payers are, as a whole, some energy as well. So again, trying to add back these asset classes that again tend to do better during this volatile market that we've had. So again, we're just trying to stay on top of it and be nimble, and that's what we're doing and making those changes when we see fit.
Well, on the political front, when we look at that, we do have the midterm election coming up on November the 8th. Very important. Right now, again, probabilities say we potentially could have gridlock in Congress. When that occurs, we've looked at the history. It's excellent.
Good thing.
The market loves it. because they understand that the current policy is probably going to remain the current policy for 2 more years. But that being said, average returns based on gridlock during this type of administration has been about 13 to 13.5% on an annual basis, 12 months after the fact. So there's some optimism there when it comes to the overall market. Yes, we got to get inflation under control. Yes, we've got to get several other items in check before we feel better about the overall market as a whole. But ultimately, there is some positive news on the horizon.
Yeah. So again, just want to come at you with those updates. Appreciate you joining us. Again, any questions about what we discussed today, feel free to reach out to us. Follow us on social media. Check out the podcast that we put out. A lot of people love to hear those. But again, if any questions, feel free to reach out. Brandon Rogers, Trent Bradshaw, Bradshaw Financial Planning, and Mind Your Money. Take care.